Lucy Cohen, and I'm the co-founder of Mazuma, the UK's leading subscription-based accountancy service for small and micro businesses. In this video, I'm going to give you a brief explanation of what the profit and loss account is. Now, you will probably be used to hearing about the profit and loss account or the terms of the profit and loss account. If you've ever watched business shows like Dragon's Den, you'll have noticed that they are obsessed with terms like revenue, turnover, gross profit, net profit. All those terms relate to the profit and loss account. So a profit and loss account basically shows the revenue and expenses of a business, importantly over a period of time, most commonly a month, a quarter, or a year. You can use time periods to compare your profit and loss account to other time periods. It's quite often useful to say, compare this March's figures with last March's figures, so you can see that year-on-year comparison. Your profit and loss account is one of the most important parts of your company financial statements. This is the place where your transactions are recorded that show the day-to-day profitability of your business. And even more importantly, it's where investors and other interested parties are going to take a look under that hood and see how your business is doing. If you've ever actually seen a profit and loss account, and I'm sure you may well have, then you'll know that it basically just looks like a list with a bit of subtotaling going through it. It doesn't look complicated. It looks very simple. But there are some important elements of it for you to understand. As with all things accounts, it is never as simple as it seems. So what does it look like? Well, at the top of the profit and loss account, which you might also see called an income statement, is your income. So this is most commonly your sales income or revenue, money you've made from selling your product or service. You'll also see in there other non-trading income such as bank interest or maybe other operating income that might be in there. Underneath this income section is where you're going to record your costs. So the first items at the top of that list are direct costs or cost of sales. And these are the costs associated directly with the product or service that you sell. In this section, you'll see things like the cost of buying stock, for example, direct labour. Cost of sales, or cost of goods sold, as sometimes you'll hear it called, represents the direct costs and direct labour costs that are incurred in the production of goods or services. So in other words, cost of goods sold are the costs that are directly tied to production, which, I don't know, if we look at the example of, say, a chair manufacturer, which is quite a nice, easy example, it can include all the following things. So things like direct materials, raw materials, stock, direct labour for wages or production workers, costs for equipment and machinery used during production, utilities such as heat and electricity for the production factory, and shipping costs for the product. So what's a direct cost? Well, if you were, say, the aforementioned chair manufacturer, a direct cost might be the cost of the wood to make the chairs, maybe some of the glue that sticks it together, or the staff that manually put the pieces together. I like to think of a direct cost as a thing that without your product or service simply wouldn't exist. Your chairs can physically exist without an advert to sell them or a shop window to display them in, but they can't exist without the wood to make them. So essentially, if you think of it that way, that is direct costs in a nutshell. Your sales income, back at the top, minus your cost of sales is your gross profit. And that's really important. Your gross profit is a really useful metric because it tells you a lot about your business. In the most basic terms, it demonstrates that real nuts and bolts of your business, what you're paying for the stock you buy, like the wood for your chairs or the staff you use to assemble those chairs, and how much you are able to sell it for. Now, if you aren't selling your goods for a high enough price, or if you're paying too much for your stock or your raw materials or your staff or your factory costs, this is the part of your financial statements that will tell you that. Underneath your gross profit section is your expenses section, and that's slightly different. This is the part that lists out all the other costs associated with running your business. So all the costs that aren't direct costs. And in here, you'll see items like stationery, phone costs, insurance, indirect staff, marketing, etc., rent. You'll also see items in there like depreciation and amortization. which represent accounting treatments of things like assets and goodwill that don't get posted to the profit and loss account all in one go. And that's because they're relevant over an extended period of time for the business. I'll give you a very quick note on those. Depreciation, for example. Depreciation applies to the accounting treatment of assets that a company buys. So an asset is something like a piece of machinery, a big expensive thing. It doesn't get posted to the profit and loss account because it is useful over a much longer period of time. So what we do with that is we post that asset onto the balance sheet of the company, which is a different financial report. And then we slowly feed the cost of that equipment, the cost of that asset, into the profit and loss account over a period of time. And we're talking usually several years. And that's what depreciation is. So if you've earned more income than you've spent on your costs, you've got a profit in your profit and loss account. And if you've incurred more costs than you have income, then you've got a loss. So how is the profit and loss account different from just, say, looking at your bank statement, which a lot of small business owners do? Good metric. But as I mentioned above with the assets and that treatment of depreciation, not everything you buy for the business is going to get recorded on the profit and loss account. Some of it belongs elsewhere in the accounts. And also accountants use something called the Accruals Concept to record your income and expenses, just to make life more interesting / difficult. And this means that items on the profit and loss account are usually recorded when they happen or when they're applicable, not when the money enters or leaves the bank account. So for that reason, many people end up asking themselves kind of classic questions. Why do I have a profit but no cash? And then conversely, you can have a lot of cash in your bank account and have actually made no profit. So there's that difference there between profit, loss and profit, loss and cash flow. So if you can get your head around how a profit and loss account works, you'll really start to get to grips with how profitable your business is.